If you walked into a coin shop right now with $100 in your pocket, what should you buy? A 1 ounce silver round, constitutional silver below spot, or should you skip silver entirely and save for gold? But here's the real question. Why are silver showcases empty while junk silver piles up? And why have some dealers stopped ordering wholesale altogether? Because the inventory is telling a much bigger story. Let's break it down. Chapter 1. The volatility. Nobody is talking about silver as moving $3 to $6 in a single day. Historically, 30 to 90 cents was considered a big move. At $80 silver, a $3 swing is nearly 4% in a day. If you're holding a 100 Oz bar, that's a $300 move. If you're a dealer locking in 5,000 ounces from a wholesaler and price drops $5 before delivery, that's a $25,000 hit. This is not normal volatility, and dealers know it. Chapter 2. The inventory. Imbalance. Right now in many shops you'll see 90% constitutional silver, fully stocked, 999 fine silver rounds, often sold out. Gold, slowly building inventory that tells us something. New stackers overwhelmingly prefer 1 Oz Arctic 99 silver rounds. Why? Because it's simple. It says 1 troy ounce, 0.999 fine silver right on it. No math required. But seasoned stackers, they're looking at something else. Chapter 3. The math. Most people ignore pre-1965. U.S. silver coins contain $1 face value, 115 troy ounces of silver. So to get roughly 1 ounce, you need about 140 face value. At $80 silver, melt value for 1 ounce, $80. Some shops are selling that equivalent constitutional silver for about $79 to $1.80. That's effectively at or slightly below spot. Meanwhile, a 1 Oz silver round at $80 spot plus $5 premium costs $85. So on paper, 90% silver, $79 toward $80 per ounce. 1 Oz round to $85 per ounce. That's a $5 difference. So why isn't everyone buying the cheaper option? Liquidity. Chapter 4. The liquidity trap. Right now, many dealers are hesitant to buy constitutional silver aggressively. Why? Because spreads have widened. Fewer shops are absorbing it. It's harder to flip quickly. So while you may buy below spot, you might not sell at a strong bid in the short term. Cheap does not always mean liquid. And in volatile markets, liquidity matters more than premium. Chapter 5. Gold on a budget. Gold is hovering around $5,000 per ounce. A $1.10 Oz Gold Eagle might cost around $571. Intrinsic value at $5,000 gold? $500. That's a $71 premium, roughly 14%. Now compare that to a 1 Oz gold coin with a $200 premium. $200 on $5,000 is just 4%. If you buy 1 per 10 Oz coins instead of 1 ounce, you're paying about $700 in total premium versus $200. That's a $500 difference. Fractional gold is convenient, but it's expensive. Chapter 6. Why dealers stopped ordering. Here's the part most people miss. Some dealers haven't ordered wholesale silver in months. Why? Because turnaround time can be 3 weeks. In a market moving $3-6 per day, that's dangerous. Instead, they're buying over the counter and reselling immediately. That's defensive positioning. When dealers shift from expansion to defense, it tells you volatility risk is elevated. Chapter 7. The gold to silver ratio signal. With gold at $5,000 and silver near $80, the gold to silver ratio sits around 62.1. Historically, above 80, silver undervalued. Below 50, silver overextended. 60-70, neutral zone. At 62, we're in ambivalence territory. That's why silver to gold swap trades have slowed. There's no screaming signal either way. Chapter 8. Physical versus paper. Psychology. There's also increasing chatter about futures market manipulation and spoofing investigations. Whether you follow that narrative or not, retail confidence in paper markets appears to be weakening. And when volatility rises and trust falls, physical demand increases. That's exactly what we're seeing. Chapter 9. So, what should you buy? If you have under $100, you do some 1 Oz silver round. Easiest to sell. 0.40 face constitutional, cheapest per ounce. If you're stacking long-term, 20 plus years, 90% silver below melt is strong value. If you're looking for a quick flip, silver is probably not the right vehicle right now. If you want gold exposure but are on a budget, be aware of fractional premiums. Final chapter. What the inventory is really saying. The real story isn't whether to buy junk silver or rounds. The real story is this. Retail demand is strong. Dealer behavior is defensive. Volatility is structurally elevated. Liquidity spreads are widening in certain products. This is not a collapse, and it's not a blow-off top. It's a transitional phase. And historically, transitional volatility phases tend to resolve in one of two ways: consolidation or expansion. And inventory never lies. Closing. If you found this breakdown helpful, subscribe for deeper macro-level silver analysis, and let me know in the comments, are you stacking 0.999 rounds or going for constitutional below spot? Because the difference matters more than most people think.